All right. Welcome to live valuation, everybody. I'm Midas Moriarty. Like we are live. Just give me a moment to make sure everything's up and running in the appropriate locations, and we will get started. Okay, everything good. So today we're going to be taking a look at ticker RGR, Sturm Ruger and Company, pistol and rifle manufacturer, retailer. But first and foremost, we kind of have to address the valuation I did actually last Friday, which pretty soon after finishing the stream, I actually took the stream down because I ran into a lot of questions about doing it. The stream in question was surrounding ticker SFRRF Sandfire Resources here. And in the stream, I had found a significantly higher valuation than you even see here, and I was very excited about it. But I was also wondering what exactly I was missing, if anything. And upon further inspection after the stream, I realized that I actually did have a mistake in the formulas in my evaluation outputs. But it was a mistake that wasn't really presenting itself in a lot of the other valuations that I had done, which is why I had gone so long without really noticing it. It had presented itself in a couple of them, but it was something that I kind of just didn't fully grasp exactly. It was like I kind of tell something was off or something I didn't fully understand. And it was always presenting itself specifically on usually the bottom valuation, the worst case scenario, or maybe like the one below that, but usually the bottom worst case scenario, and usually on stocks that had a significant amount of default risk. And what the issue was how I was applying the default risk and applying the net tangible value of their book value to the percent chance of them defaulting. Like if they do default, then we assume that they're going to have to liquidate all their assets, and therefore you get the leftover of whatever their tangible book value is as the value of the stock on the percent chance that they're going to default, with the percent chance that they're not going to default being the valuation you get from the operating assets or the income. So basically any stock that I had a significantly low worst case scenario with a significantly high default risk with any significant amount of tangible value, as long as those three things were happening, then I was running into this issue where the valuation was actually getting pushed up way too high because of an issue in the valuation. As I said, this only presented itself in a couple of the other stocks I'd valued, specifically commodity companies and mining companies it was presenting itself in. But when we did correct for all of those things in all of our other valuations, so now all of our valuations as listed right here are correct and accurate. And the one thing I did find was that a lot of the valuations were off by proportionally a similar amount of value compared to where they are in the scale here. So what that means is that the relative position of all the companies we've looked at compared to each other didn't actually shift all that much. It's just the absolute value that shifted. So overall, strategically, how that affects all of the decision making that we've been doing over the last several months is that it doesn't actually affect that much, which is good. It means that it's a mistake that wasn't costing me money. But either way, so getting back to SFRRF, the stream, I did take it down. And so since I did take it down, I figure at some point or another we need to sort of go over it again, because I did correct all of the details that were wrong in the valuation, and I still found the valuation to be outstanding enough that I actually did start a position in the company. So therefore we should probably talk about it so that other people can maybe take hold of this opportunity. So let's get into it. Ticker SFRRF, Sandfire Resources, Australian copper, silver, gold mining company. Primarily copper. That was another issue that I had, was that initially I had actually done my commodity pricing model against gold for them, because I had mixed them up with another company that I was looking at. I was looking at a lot of Australian mining companies, so I was kind of getting a few of them mixed up in my head. But it turns out that the correlation between the commodity pricing and the revenues for gold and copper for Sandfire is relatively low, only about 14%. So it didn't actually change the valuation that much to shift from gold to copper. But either way, well, we have a corrected valuation based off of copper pricing. So 5 years ago, Sandfire Resources had sales of $497 million. And in the most recent year, it was $813 million, which gives them a sales growth of 10% per year for the last 5 years. Sales to capital ratio is about 1.46, which is really, really high, significantly higher than their industrial expectations, about twice as much, honestly, with returns on invested capital of around 30%, which is very, very high. Debt to equity ratio is basically zero. They basically have zero debt, and as a result, they basically have zero default risk. The profit margins adjusted for development costs comes to about 20%, which is high relative to their industrial average of 16%. So they have high profit margins and extremely high sales to capital ratio, which is part of how they achieve the really high returns on invested capital. Either way, what that does show is a strong competitive position in their industry to be able to have high on both of those ends. Usually if you're low on one, you're high on the other, you're high on one, you're low on the other. It's usually a balancing act. So being high on both of them is pretty great. So they have profit in the most recent year of $194 million, and they're currently selling for a price of $431. I'm pretty sure my position was actually started at $435, though there's some complications to that we'll get. I skipped the slide accidentally. The treasury currently is selling for 1.65%. Crazy to see it up over 1.5 again. We'll see if we get closer to 2. The equity risk premium today is back down to 4.8%. We had topped out a little over 5% a little bit ago, not too long ago. But the discount rate that we get for Sandfire Resources after adjusting for industrial risk, debt, and taxes, we come to a discount rate for them of 10.37%. And they currently are yielding 5.89% on their dividend. So it is a somewhat irregular dividend. They shift it up and down with their cash flow. Being that it's a commodity company, we use a commodity pricing model where we distribute the chances of commodity pricing to be roughly even across the board, a mixture between historical past quartiles of prices for the commodity mixed with a projection of commodity pricing based off of money supply measures. So the mixture between those two, relatively agnostic to the highs or the lows of the outcomes. We end up with copper pricing 5 years from now anywhere from 74 cents per pound to possibly a high of $7.74 per pound. On an expected basis, we are assuming about $4.14. Just for comparison, the current price is $4.38. The average price for the last year has been $3.84, with a analyst expectation for 5 years from now of about $4.46. So I think our assumption is pretty conservative. We're conservative compared to the analysts. We're relatively conservative compared to current pricing, and we're conservative compared to current average pricing. So I think that overall, an expected value of $4.14 per pound of copper is not too bold an assumption at all. But either way, based off of those ranges of copper prices, we end up with sales expectations of 420 million to possibly 746 million, which is, in any way you spell it, a decline in sales relative to their most recent year. But that's just what the commodity pricing correlation spit out for us. We don't make the decision based off of commodity revenues. Based off what we think, we make it based off of projections of commodity prices. What that tells us is going to be their sales. But either way, with declining sales, that doesn't seem to be a problem for this particular company. We end up with sales to capital ratio expectations of 1.35, which is a little bit lower than the current levels. We're assuming it gets compressed over the next 5 years. Returns on invested capital will also likely get compressed down because of that, from 30 to possibly around 23% on a distributed basis. We're assuming that they'll probably have to take on a little bit of debt to achieve this, maybe going up to as much as 5% compared to their 1% right now. That's a significant increase, but overall not very much debt. This does result in a pretty significant amount of default risk for them, mostly on the worst case scenarios. But either way, it comes up to an expected value of about 4.14% per year, which is pretty significant per year for the next 5 years. But we end up with a expected profit margin for them of about 15%, which is also a compression from where they're currently at. But again, that makes sense to see margins and capital ratios get compressed over time. But either way, that comes up to a distributed profit level of $97 million, which, as I've said before, kind of understates things. The distributed level of profit is usually not an accurate way to look at it. It's more about just looking at the actual range that you see based off the outcomes, because of the fact that this is downstream from so many other factors. It implies that this is our actual expected net income, but because of the negative outcomes, it's probably weighing it down a little bit more. But we can assume that the profit's not going to really be that low. It's just the range of outcomes that matter. But either way, based off of the expected range of incomes, we come up to a present value based off of the discount rate that we're using of $7.91 per share, which is 83 to 84% higher than the current price. 5-year forward value targets, unadjusted for the dividends that they pay out, gives us a target price 5 years from now anywhere from $4.76 to possibly a high of $24.74. Again, unadjusted for the dividends that they'll pay out. On an expected basis, we will assume that it'll be about $12.95. Based off of that price and the price that it's currently selling at, we expect the CAGR of about 24.62% each year for the next 5 years on this stock, which is an extraordinary return CAGR to be looking at. Pretty high margins, pretty great sales to capital ratio, pretty great returns on invested capital. So all the qualitative factors also look really good. And so as a result, our personal value score for them is extraordinarily high because they come off looking great on both quantitative and qualitative factors. The short-term pricing number is kind of irrelevant for this one because we don't have an analyst EPS growth rate, so it's not actually going to be spitting out a meaningful number, so we can just ignore that. So this is a really great opportunity. You might be asking yourself, what's the catch? What's the deal here? Why is this company such a great opportunity? Well, there is some complications. There's some catches to it, which is part of the reason that it's probably such a low valuation. So it's up to the individual to decide if they can overcome those issues. Specifically, that they are a foreign listed stock and it's not an ADR. So that means that if you're going to try and invest in them, depending on what brokerage you have, you might have to deal with fees or even just not having access to it in the first place. The brokerage that I had access to, I did actually have to pay a $50 foreign settlement fee for each transaction on this particular stock. So depending on what size purchases you're making, that can make a pretty significant difference in what you're doing. If you're only going to buy $500 worth of this stock, well, a $50 fee comes out to be pretty significant. It's 10%. If you're going to buy $5,000 worth of stock, well, then that's only about 1% of a fee. If you're buying $500,000, it becomes negligible. But the point is this is a really small company, so really large investors are like big whales and stuff that have hedge funds and mutual funds and all that. They're not really going to be able to invest in this stock. So this is mostly for the little guy meaning people who still have millions and millions of dollars. But the point is how many of those people are also looking as far. So there's a lot of things going for it. It's small. That means big institutional investors can't get invested in it. It's foreign. That means a whole lot of Americans that otherwise might have the wherewithal to look at it, and Europeans and other people from more developed economies that have a lot of investment funds and might otherwise have the wherewithal to look at it, might be a little unattracted to it because of the fact it's foreign. Depending on which brokerage you're using, that might come with foreign fees, which means that if you're an extraordinarily small investor, kind of like myself, well, then that means it's even less attractive to you. And then 4, it's also a commodity company. which we've talked before, commodity companies are often shied away from because of the complications involved in valuing them. So there's a lot of reasons why this stock is as low as it is. That basically just has to do with it being a difficult and complicated stock value, and a difficult and complicated stock to make a position in and to actually capture. What that does mean is that this is a great opportunity for anybody that wants to capture it, but you do need to do some math and some figuring to figure out how the fees might work into this cogger and lower it. Because like I said, I myself am a relatively small investor. My portfolio is only in the 5-digit range. So trying to remain as diversified as I do means that all my positions individually are actually really small. And as a result, a $50 fee for a portfolio as small as mine actually does make a pretty big difference if it's on an individual transaction. So that means that I'm limited in how many personal lots I can throw into the stock. However, the returns are high enough to overcome it to a significant degree. I did the math myself, figuring out like if I buy this many shares, how much does that lower the cogger? If I buy this many shares, how much does that lower the cogger? So before anybody jumps into the stock, they should definitely look at whatever brokers are using, look at what fees are required to actually get it, and see how that changes their total return. Because it's not returns before fees and taxes that matters. It's returns after fees and taxes that matters, right? Like that's the real return you're actually going to capture. So great opportunity. I did buy into it, but that's the catch. That's the difficult part, is that it has all those issues related to it. Really small commodity company. It's a foreign commodity company, and it's a foreign commodity company that for a lot of brokerages involves fees. The brokerage in question that had that $50 fee that I'm using, by the way, is Fidelity. It wasn't available off of Robinhood. Those are the two brokerages that I use. So maybe your brokerage is going to be more friendly with you for it. I don't know. It's up to you to decide. So either way, that's Sandfire Resources. I wanted to discuss and cover that and not just kind of forget about it, especially since it was such a great opportunity. And I didn't really want to take that stream down, but like I said, it had issues with it, and I was just like, okay, better if I just take this down and readdress it later on in the future. So now we will actually get on to the topic of today's stream, which is Sturm Ruger. Sturm Ruger, firearm manufacturer and retailer. Ruger, Sturm, both brands of their own. They also recently acquired the Marlin brand of rifles. So I already started and got the prep work stuff done ahead of time. I've already done the first year of financial data. We do have a full 10 years for this one. We don't have a whole lot of conferences to listen to, but we do have a little bit of that, and I'll play that while I'm doing the financial statement. Oh, it's not. I thought this was the. Oh, this is the future one. My bad. We could have just listened to that elevator music for a full 15 minutes if we really wanted to, I suppose. But heard their past. Well, we'll just listen to the general meeting right now first.
Good morning. My name is Ron Whitaker. I am the chairman of the board of Sturm Ruger and Company Incorporated. It is my pleasure on behalf of the directors, officers, and employees of the company to welcome you to our 2021 annual meeting of stockholders. In consideration of the ongoing COVID-19 pandemic and related CDC guidelines, the board concluded that it would be prudent to have a virtual shareholder meeting again this year. On the positive side, we believe this format will allow greater participation by stockholders who otherwise might not be able to attend a live meeting. As is our custom, we will conduct the business portion of the meeting, followed by a presentation by Chris Killoy, our president and CEO. After that, we will entertain questions from stockholders, which may be submitted via the web portal. In addition to Chris and me, Tom Deneen, our CFO and Senior Vice President, and Kevin Reed, who is our General Counsel, Corporate Secretary, and a Vice President, will be participating today on behalf of the company. For the record, I'd also like to advise you that all members of the board are on the call. I call to order the 2021 annual meeting of stockholders of Sturm Ruger and Company Incorporated. Please note that the polls are open. If you are a stockholder and have not voted, or you have voted by proxy and wish to change your vote, you can do so via the web portal. We will be closing the polls shortly, so please vote now if you plan to vote during the meeting. Also, stockholders may submit questions through the portal by typing a question into the space provided and clicking the Submit button. If you are asking a question, please be mindful of the rules of conduct for the meeting, which are posted with the meeting materials. Our agenda for the formal matters to be brought before the stockholders today will be as follows: to take care of the necessary appointments and documentations for the meeting, to establish quorum, and to take votes on the items of business properly brought before the meeting. These items of business are, first, to elect 9 directors to serve on the board of directors for the ensuing year. Second, to ratify the appointment of RSM US LLP as the company's independent auditors for the 2021 fiscal year. And third, to hold an advisory vote on the compensation of the company named executive officers. First, I'll deal with the appointments. As the company's bylaws provide, I will act as chairman and conduct the meeting. Corporate Secretary Kevin B. Reed Sr. will act as secretary of the meeting and was appointed as Inspector of Elections before the meeting. As inspector, Mr. Reed will determine the presence of a quorum and serve as judge on all matters requiring a stockholder vote at this meeting. Now I'll deal with the certification of the meeting documents. Documents concerning the call and notice of this meeting will be filed with the records of the company and are available for inspection by any stockholder upon request. These documents include a copy of the notice of availability of proxy materials, an affidavit of mailing certifying that the proxy materials were mailed to the stockholders of record of the company, the signed oath and report of the Inspector of Elections, and a list of registered stockholders entitled to vote at this meeting, which also is available via a link on the web portal. We have previously supplied each stockholder of record with a notice regarding availability of proxy materials that contained instructions on how to access the company's proxy statement and Form 10-K. The bylaws of the company provide that a majority of the voting stock shall constitute a quorum for the transaction of business at this meeting, based on proxies and stockholders present. Mr. Reed, may we have a report of the Inspector of Elections on whether or not a quorum is present?
Mr. Chairman, the proxies received by the company in connection with the 2021 annual meeting of stockholders of the company has been examined and have been found to be in proper form, and there are present at the meeting by proxy at least 14,156,424, or 80.5% of the shares outstanding of the company which are entitled to vote, and such shares do constitute a quorum for the transaction of business at the meeting. Also, there were no additional stockholder proposals for business for this meeting properly filed with the corporate secretary in accordance with the advance notice requirements of the company's bylaws. As such, the business of the meeting is limited to the matter set forth in the agenda.
Thank you. Because a quorum is present, this meeting will proceed. Please note that we will give stockholders an opportunity to comment on the proposals themselves after all proposals have been presented. The first order of business is to elect 9 directors for the ensuing year. Those directors receiving the highest number of votes, or a plurality of votes, of shares present in person or by proxy at this meeting will be elected as directors of the company to serve until the 2022 annual meeting of stockholders and until their successors are duly elected and qualified. As indicated in the company's proxy statement, the board of directors has nominated the following persons to serve as directors: me, Ronald C. Whitaker, John A. Cosentino Jr., Michael O. Pfeiffer, Sandra S. Froman, C. Michael Jacoby, Christopher J. Colloy, Terrence G. O'Connor, Amir P. Rosenthal, and Philip C. Woodman. The company's bylaws require that a stockholder give advance notice to the company in order to nominate any person as a director. Because no such notice was received, I hereby declare the nominations for directors closed. The second order of business on the agenda is the ratification of the board's appointment of RSM US LLP as the company's independent auditors for the 2021 fiscal year. The affirmative vote of at least a majority of the shares entitled to vote and represented in person or by proxy at this meeting is required to ratify the appointment of RSM US LLP as our independent auditors for the 2021 fiscal year. The third order of business on the agenda is an advisory vote to approve the compensation of the company's named executive officers as described in the 2021 proxy statement, otherwise known as the Say on Pay vote. While the vote is not binding on the board of directors, we will review the voting results and take them into consideration when making future decisions regarding the compensation of our named executive officers. The affirmative vote of at least a majority of the shares entitled to vote and represented in person or by proxy at this meeting is required to approve on an advisory basis the Say on Pay vote. If any shareholder would like to make a comment regarding any of these 3 proposals, please submit your comment now through the web portal. Because we are all remote and there is a slight delay, I will pause and allow stockholders to comment. Mr. Reed, are there any comments submitted on the proposals?
No, Mr. Chairman, there were not.
This concludes discussion on all formal matters to be brought before the stockholders, and we will finalize the vote on these matters. Mr. Reed?
As the chairman noted earlier, the polls have been open throughout the meeting. Any stockholder who has not voted or voted by proxy and wishes to change their vote may do so by clicking on the voting button on the web portal and following the instructions there. Stockholders who have sent in proxies or voted via the telephone or internet and do not want to change their vote do not need to do anything at this time. We will pause for a moment to permit voting and then close the polls. So given the delay and remoteness, we'll give it a few seconds here. The polls for all voting matters are now closed at 9:10 a.m. on May 12, 2021. Mr. Chairman, we've completed the tabulation of the votes with the following results. On the first proposal, the election of directors, I report that the nominees for election to the board have all been duly elected. On the second proposal, the ratification of the independent auditors for 2021, I report that a majority of the shares present and voting were cast for the approval of RSM US LLP as the company's independent registered public accounting firm for 2021, and as such, their selection is therefore ratified. On the third proposal, the advisory vote on the compensation of the named executive officers as presented in the proxy statement, I report that a majority of the shares present and voting were cast for the approval of the compensation of the company's named executive officers.
Thank you, Mr. Reed. The chair declares that all of the nominees for director named in the proxy statement have been elected and 2 proposals have passed. I now direct that Mr. Reed prepare a written report of the results of the election and include them in a Form 8K. This concludes the formal business of the 2021 annual meeting of stockholders. In order to help ensure that the meeting runs smoothly, Chris Killoy pre-recorded the presentation he usually gives live. Following the presentation, we will have a short question and answer period, which will be live. Stockholders wishing to submit a question for consideration should type their question into the block provided in the web portal and click Submit. Again, if you plan to submit a question, please be mindful of the rules of conduct for the meeting that are posted with the meeting materials. In the interest of fairness, we ask that stockholders only submit 1 question each. Guests are welcome to listen to Mr. Killoy's presentation and the question and answer period,
Right.
but only stockholders of record
Done.
on the record date
Three
are
downs.
permitted
Go.
to submit questions. At this time, I would like Kevin Reed to read a cautionary statement, after which we will play Chris's presentation. Kevin?
Thanks, Ron. We want to remind everyone that statements made in the course of this meeting that state the company's or management's intentions, hopes, beliefs, expectations, or predictions of the future are forward-looking statements. It is important to note that the company's actual results could differ materially from those projected in such forward-looking statements. Additional information concerning factors that could cause actual results to differ materially from those in forward-looking statements is contained from time to time in the company's SEC filings, including but not limited to the company's reports on Form 10-K for the year ended December 31st, 2020, and of course on the Form 10-Q for the first quarter of 2021, which we filed last week. Copies of these documents may be obtained by contacting the company or the SEC, or on the company's website at ruger.com/corporate, or of course the SEC website at sec.gov. We do reference non-GAAP EBITDA. Please note that the reconciliation of GAAP net income to non-GAAP EBITDA can be found in our Form 10-K for the year ended December 31st, 2020, and our Form 10-Q for the first quarter of 2021, both of which, again, are posted on our website. Furthermore, the company disclaims all responsibility to update forward-looking statements. Ron?
Thank you, Kevin. In a moment, we will proceed with the recorded presentation from Chris Killoy. Again, stockholders wishing to submit questions should type into the space provided in the web portal and click Submit. Following the presentation, Chris will respond to questions, which will be presented by Tom Deneen on behalf of the shareholders. Operator, please play the presentation.
Quarter of this year, our commitment to strengthening our workforce, and our continued battle with the struggles caused by the COVID-19 pandemic. I was also able to answer questions regarding our operations, employment status, and plans for the rest of 2021, including an update on the Marlin product line. Today, in light of this being our annual meeting, we wanted to take some time to look back on what has been an unprecedented year for the world, our country, this industry, and our company. To do this, I would like to play a short video highlighting our journey as we navigated this very difficult but ultimately successful year for our company. And that's because of our people.
Founded in 1949, Ruger quickly became known as an innovative manufacturer of rugged, reliable firearms for the consumer market. Since the beginning, our mission of designing and building great products that an everyday American could afford resonated through our company. Supporting those products with unparalleled customer service, was natural for our team of associates who loved what they did and cared for the customers they served. As we head into our 72nd year, we want to look back on what has always made Ruger a great American company. More than the products that we make and the financials we report, the heart of Ruger is our people, the rugged, reliable Ruger Americans that bring our values to life each and every day that they show up, not just in the workplace, but also in their communities. Our people are who drive our business forward, give us sustainable competitive advantage, and are the reason why you can invest in Ruger for the long haul. This past year was a year like no other. Our people, like our country, pulled together in the face of a global pandemic and nationwide social unrest and political acrimony. In these difficult and uncertain times, our people rose to the challenge. After all, Ruger is more than a gun company. It is a family of hardworking people who care about each other, who care about the company they work for, and who care for the communities they live in. They are the people that exemplify our American values. Over the past year, each of our diverse manufacturing facilities across the country have made it their mission to positively impact their communities. They did so during these difficult times by giving back to those in need and donating their time to important causes. With acts like this, you can see how our people make a difference every day, even through the toughest of times, by showing integrity in being there for their communities. The commitment these men and women demonstrate to their neighbors carries over to the workplace as well, and is best illustrated by the respect they have for each other. With so many Ruger associates having spent decades working for our company, oftentimes alongside their family members, our people demonstrate a professional loyalty and dedication that is unparalleled and extremely rare to find in the fast-paced society of today. Our people have a shared respect for one another and consider each member of the team as family, treating the personal life milestones of their coworkers as something to be celebrated at work as well. And that extends into how we have grown to lean on each other and share our personal lives together, further building the bond between community, work, and family. That's where our core value of teamwork comes in. This past year, our associates pulled together to accomplish the impossible, persevering in the face of a global pandemic to keep each other and our communities safe by implementing new safety protocols, keeping our facilities open, and now developing vaccination initiatives. Throughout all of this, our people kept adapting and expanding our manufacturing processes and capabilities to meet unprecedented levels of demand, even pulling together to manage the successful acquisition of Marlin and the transfer of those associated assets to existing Ruger facilities, and having already established the production line for where new Ruger-made lever-action rifles will be produced later this year. And most impressively, our people helped us achieve major milestones in production, all while maintaining our first-class levels of customer service that we have come to be known for. That spirit of teamwork is what motivates our tradition of excellence and inspires an environment of continuous improvement and, our greatest strength of all, innovation. This has been the recipe for our growth since the beginning and continues to be the basis for growing our company in the future. Our people innovate not just with new product development, as was evidenced in the recent launch of our exciting Max 9 pistol, but in all areas of our business, including expanding our production capacity, readying our facilities for the development of Ruger-made Marlin firearms, expanding our recruiting initiatives nationwide with drive-through job fairs, and developing a robust remote work environment for our corporate associates that keeps them plugged in with each other and our manufacturing facilities on a real-time basis. This spirit of innovation is one that never rests at Ruger and is one made entirely possible through our other core values of integrity, respect, and teamwork, and the people that bring them to life. This is Ruger. These are our people. This is America.
As you can see, our people drive our culture and that culture allows for the great success and growth we have seen over this very difficult past year. Personally, I want to welcome our many new employees. You are the people we speak of. You are part of this family. Growing from about 1,500 employees to just under 2,000 employees over the past 12 months has made us stronger, better, and more prepared for what lies ahead. Thank you. And although I wanted to focus this annual presentation on our associates, there is another group of important people that need to be acknowledged, our customers. As I discussed last week, the record sales over the past year were exacerbated by the tremendous growth in new or first-time gun owners. To you, I say thank you and welcome to the family. Lastly, and most important for this meeting, I want to sincerely thank our shareholders, those who believe in our strong and stable management team and appreciate the return that we work so hard to provide to you. Let me offer some high-level insight to our financial performance over the past year or so and why Ruger is such a great investment. Let me start with the tremendous and steady growth that we've had in sales over each of the last 4 quarters. Jumping from just over $120 million in sales in Q1 of 2020 to just short of $185 million in sales this past quarter. Let me illustrate this growth in another manner. As our revenue increased over this period, we also saw our profitability increase significantly over that time, growing from 29% in Q1 last year to $72.6 million this past quarter, or almost 40% of revenues. This is an outstanding achievement and represents one of our most profitable quarters ever. That growth equates to similar record growth in earnings per share, from 87 cents last year to over $2 this past quarter. Of course, this financial success was driven by our ability to increase production and limit promotional activities over this period, with production rising from just over 360,000 units to over 540,000 units last quarter, which is amazing considering our people were able to do this during a pandemic with limited hiring opportunities and working through supply channel constraints. As I close this presentation portion of the annual meeting, I want to leave you with a comment that you may have heard me say in the past, and one that I sincerely mean. When I think of our business, our company, and this industry, there is no company, no leadership team, or group of people that I would rather be associated with than the folks at Ruger. As an investor, you should feel the same. As a company, we continue to offer a strong balance sheet, stable leadership, sustainable growth, strong investments, and a high value proposition for our consumers. As our CFO, Tom Deneen, often reminds me, we established a strong game plan some years ago, and that plan continues to work for us today. We maintain a conservative balance sheet, we're disciplined with our capital allocation, and we maintain a constancy of purpose with a consistency of execution. Operator, I'll take our first question.
Hey, Chris, we've got a couple of questions from shareholders. The first is, do you see the classic Marlin 39 and 39A coming online in the next wave of Marlin rifles?
Thanks, Tom. The first guns that we're going to be focusing on the Marlin line are going to be the centerfire lever action rifles. That's going to be the model 336, 1894, and the 1895 in the larger calibers. The 39 and 39A, some may recall, are the 22 caliber lever action rifles that were made for many years by Marlin. We're going to look at that, but they are definitely not in the first wave of products that we're introducing. Again, we'll focus on the centerfire lever actions. That line is coming along very well down at our factory in Maiden, North Carolina. The folks down there have done a phenomenal job when they removed the equipment from the Remington facilities, getting it down to our factory and getting ready to begin production. We also have some of that equipment up in our factory in Newport, New Hampshire, getting ready to produce the wood stocks for the Marlin line. So we're excited about it. But with regard to the 39 and 39A, we're not sure where that'll be in the batting order.
Very good. Thanks, Chris. The next question, do you have any comments on the NRA's issues?
Well, the NRA, of course, is embroiled in certain legal matters that wouldn't be appropriate for us to comment on. But we've been longtime supporters of the NRA, and of course, the NRA has been a champion of Second Amendment rights for Americans for decades. And we look forward to their successful resolution of the challenges that are facing them, and we're watching like everyone else at this point.
Good. That's all the questions we have, Chris.
All right. Well, thanks, Tom. I want to thank all of you for your interest in Ruger and participating in our annual meeting of stockholders. Ron?
Thank you, Chris and Tom, and thanks to the stockholders for those good questions. There being no other business to come before the meeting, the 2021 annual meeting of stockholders of the company is adjourned. On behalf of the Board of Directors, I would like to thank you for attending the meeting and for your continued support of the company. Good day.
Accidentally skipped a year, so it's probably going to take a little bit longer to do this. Okay. Got extra time today. Must be working it up. Same column. 3 minutes. Really great. Only 2 left. Left, and then we can actually do analysis. Net sales, cost, selling, plus general administrative, other. Income, expense, royalties, and other. And then tax. All right, then the cash flow statement, depreciation, amortization, gain, loss, and sale of assets. Sum of change of working capital. X, net it out. Proceed exercise options. Netting out the options from purchases. Dividends paid. Cash. Bulls. Or everything else current. Property. Everything else. Retained earnings. Netted out treasury stock. Accumulated other. All right. One more to go. We can call it a day. Okay, now to final cash statement. Disposal of assets. Sum of change of working capital. Account payment. Alright, debt changeover. Net out repurchases. Dividends. Alright, now the final balance sheet. Cash. Receivables. Net inventories. Everything else current. Property. Appreciation. Everything else. Liabilities. Payables. Other liabilities. Other liabilities. And equity. Outstanding, excess, retained, treasury, accumulated other. All right, and there we go. Now, all of the financial data. Take a look, see what we've got on. Interest rate that's throwing it off is, let's just go ahead and throw it to the list. Interest rate. Don't get too excited by that. Lots of things to adjust. For the record, the revenues I have placed in here are actually in line with Smith & Wesson's. This is the exact same set of assumptions that I had put on my Smith & Wesson valuation as far as revenue and probability distribution. I just kind of threw it on here because just needed sort of a baseline to look at, and I wanted it to be in line with that because a lot of the expectations about the industry are going to be roughly the same, but based off of the differences in how that they've handled their business in the most recent years, the differences in their capital spending on acquisitions does change that a little bit. It's probably not quite the same scenario for Sturm Ruger. It could be a little bit lower on this this like low end of things kind of base. We'll see. But there's a lot of other factors, like I said, that have to be taken into account. So we will look at that. Debt to equity ratio, basically 0% debt. So probably not high. We can set it to 5%. They've basically never really had much debt. So you can kind of assume that they won't be acquiring a huge amount of debt. That appears to just be the culture of their company, which is cool, I guess. So let's just put those in there. Sales to capital ratio is probably all over the place. Yeah, wow, look at that sales to capital ratio. Very, very high sales relative to capital base. It's been getting lower and lower and lower all the time, and it spiked up last year. So let's see, if we look at the 3-year average for this time frame right here, that gives us an average of 2.32, which is a little bit higher than the current situation we're looking at. Let's see if we pop this up to 3. 2.32, 3.45, so you could say 3.5 would be a good point. But 0.5 is probably too low for a base. 1 might be a better base. Puts everything in line with it. 2.32 being the average from the prior year, prior to 2020 3-year average. So this puts it a little bit lower than that. I think that's a pretty good range of things. Then we could have to adjust the analyst one. We could put this at also 2.25, I suppose, and to center it. See, and that corrected a lot of the valuation loss they had. So sales to capital was definitely a huge part of it. They have a very, very high sales to capital ratio. Now we do need to adjust for the margins. What are their margins like? So margins assumptions that are put in place are not terribly far off that currently. So that's fine. Let's take a look. 2019, the 3-year average was 9.38, and in the most recent year, it's more like 15%. If you look over the long run average prior to 2020, it was 11.37%. And long run average since then, 11.79%. So still 11 to 12%. Seems to be the kind of long-term average, at which point you could argue that this should be a little bit higher. 17 or 18% would be reasonable range. 18%, but maybe also vying towards the low end of things. Or, well, let's just leave it there. I was like, because I believe this is about 18, but then maybe lower this a little bit further. But let's cap it at 17 and then cap it at 5. But then this could maybe go to 11. You could argue about it. Like I said, you could put this at 4. Putting this at 18, make it a wider band, roughly the same. It does actually improve things slightly to do it that way. You could argue it should go lower. Yeah, so it's arguable at that point where you would want to center the margins, but I think a good 11% margin in the long run is pretty good, especially considering how high their sales to capital ratio is. So that's just a fact. Them being really high sales to capital means that we're pretty lucky to even get the margins at that level, to be honest. Okay, so beyond that, let's see, there's double check the tax rate, 28%. That's a healthy expectation to lay in. Returns on invested capital for the last 3 years has been 23%. Prior to last year, it was an average of 21 to 22%, so it's a little bit higher than the most recent year. Their cost of capital is like 5.5%. Cost of equity roughly in line, similar as that. I could argue it should just be 1 for that, which would not really shift things that much, mostly because of the fact that they basically have no debt. So it doesn't really make a huge difference about how we think about the debt, since the debt is basically non-existent. Yeah, well, you could argue that I should adjust some of these things. Like maybe this is still too rough. Be negative 12%, cap it to 8%. How much of a difference does that make? Not really that much of a difference. I think this is the more reasonable range of things to assume. I do think I want to adjust the probability distribution away from what we had for Smith & Wesson. Smith & Wesson had the situation where they had made the large acquisition, and they also had a larger share gain from last year than Ruger did. So it's like I wanted to lean a little bit further into the negative outcomes for that particular one. So for this one, I don't really feel that way. In fact, I would almost feel more likely that it would be on the positive end in their particular case. Because we still have 40 here, so it's still a pretty heavily weighted situation, and that still gives us a revenue expectation of -1% per year for the next 5 years. So I think that's a pretty healthy assumption to have. How does that shift everything else? Net margins still basically in line. Returns on invested capital still in line. Sales capital ratio still in line. So I'm pretty comfortable with all of those assumptions. The only thing left to do at that point is to adjust the default risk. Take a look. They have 0 default risk right now, and probably basically have 0 default risk in general. Do basically have 0 default risk. We'll leave these 2 scenarios at 0. I guess we can afford. Okay. Anything else? I think that's going to do. I don't see anything else that I feel like adjusting. Yeah. Ticker RGR. Sturm Ruger and Company. U.S. Treasury is trading for 1.65% today. Equity risk premium we have is currently 4.8%. The discount rate that I get for Sturm Ruger after adjusting for a risk gets me 5.52%. They have a dividend that is projected to pay 6.24% currently. Sales 5 years ago was about $551 million. Sales in the most recent year was $569 million. Their sales basically flat for that 5-year period, slightly up. Sales to capital ratio is 2.04, which is pretty high. In fact, it's higher than their industrial average, which was already pretty high. So that's pretty awesome. Returns on invested capital are 23.6%, also pretty sweet. Debt to equity ratio of almost 0%. Some debt would actually probably help them. That's just, to be honest. I mean, if they can get good quality debt, which they may not be able to get quality debt, so that might be part of the reason. So it's like, it could be that because of their industry that they can't get very good serviceable bond terms. So it's actually just cheaper to fund through equity and earnings. So this may be what's good for them. But the point is, it could be that adding some debt would. Either way, they have no debt and no default risk as a result of that debt. Their profit margins in the most recent year was 11.34%, which is pretty outstanding compared to the industrial average we'd expect for them of 4.19%. So they are high on both sales capital ratio and profit margins, which is part of the reason they have such high returns on invested capital. But as I was saying with the Sandfire at the start of the stream, when you have high sales to capital ratio and a high profit margin, that is a good indicative sign of strong competitive position. Generally speaking, if you have high of one, you have low of the other, whichever one it is. Generally, they're kind of related to each other. Either you're keeping a huge amount of the revenues, or it's easy for you to get revenue. It's not usually that you get both. So seeing a company with both is awesome. That's pretty cool. 11.434 isn't really that high of a profit, but compared to the industrial average, it's pretty high. It's not terrible. It's not single digits. It would be better if it was over 15, closer to 20. That would be proper high. But yeah, it's not bad. Not bad. But that is actually a high capital. Either way, so profit in the most recent year of $90 million. The present price they're selling for is $79.72. And the probability of distribution that I'm using for them is heavily weighted towards the middle, with a slight leaning towards the positive end of things. The fourth model, and part of the reason I do that is because the distribution of sales expectations I have already leaning towards a negative anything. So we lean positive outcomes towards a negative anything, but then the probabilities we tilt towards the positive. So as a result of that, we end up with sales expectations of anywhere from $252 million in the worst case scenario, possibly $916 million in the best case. And that gets us a distributed revenue expectation of $559 million in the 5-year forward period, which comes out to be a decline of 1% per year for the next, so relatively flat, but slightly down. We're projecting that their sales to capital ratio is actually likely to climb a little bit to 2.28, puts it back in line with where they've been historically in the recent past. And returns on invested capital I expect to also climb a little bit as a result, 6.5. And debt to equity ratio, we're assuming they take on a little bit of debt. They very well may not, but it doesn't really affect their value that much unless on much larger. But either way, as a result of taking on that debt, they have a little bit of default risk, but it's effectively zero. It's really, really close to zero per year, so it's not a huge deal. And then the profit margins, we expect to stay in the same range. We expect it to actually come down slightly, maybe to about 11.15% on a distributed basis. And then that gets us profit expectations right here. On a distributed basis, we're assuming about $66 million. But again, the distributed profit is a little bit less meaningful. It's more about the range of profit meaningful. But as a result, with the discount rate that we're using, we come up with a present value of $84.81, which is 6.5% or so higher than the current price, slightly undervalued. 5-year forward value targets, we project it to be worth in 5 years anywhere from $47.97 to possibly a high end of $244.43. Those prices again are unadjusted for the dividends that they'd be paying out. It's the total value that you'll be getting. But on a distributed basis, we expect the price to be $110.94, which based off of the price that's currently selling for, gets us an applied return for the next 5 years of 6.83%, which is slightly higher than it's a little bit higher than their discount rate, and it's slightly higher than the market beta, but it is not a very impressive return overall. Because of the pretty strong qualitative factors, though, that even though they don't have very highly strong quantitative factors, the qualitative factors do come out very nicely. So as a result, they still end up with a value score of 0.95, which isn't amazing, but it's not bad, especially considering it's not a very high return potential. But either way, definitely not interesting or attractive enough for me to want to start a position. But good to add them to the watch list. We had already done Smith & Wesson, which is a little bit of a better buy right now as of this exact moment, though I'm not buying either one. But you know, nice to have two gun players in the watch list. We'll watch them. I don't know, it might be some bad news at some point. They'll cause a bunch of drama and cause their stocks to drop 25% or something in a day. So nice to have them valued up and ready to go so that we can think about whether or not we want to buy them when that opportunity comes. Short-term pricing metrics not going to be very meaningful for this particular one because we have a 5-year forward EPS target for them. So pay no attention to that. But this is what we generally make our decisions on. And doesn't entice us to make any sort of decision today. So that's going to be it for us today. This was Sturm Ruger. I was looking at the list of companies that we've been looking at, trying to figure out what we want to do next, and I was kind of reordering them a little bit. Which I've come to this list and showed it several times over, and we've kind of shaken the list up and moved them around as we grew it, partially because of as I look at a company that sounds interesting, I have to decide whether or not I can actually invest in it, figuring out whether or not it's a foreign stock, if there is an actual ADR, if fees involved, if the ticker is even available at the brokerages that I purchase things from. So I've run into multiple stocks that I wasn't actually even able to buy from this list, so it would be pointless for me to value them in the first place. So the point is I've kind of had to trim the list a little bit and reorganize it and reorder it and figure out what the actual ticker for the ADR is, if that's the case. But either way, so this is actually a more complete list. I've actually already done that work. All of these are confirmed that I can in fact value I can in fact invest in. Can in fact value is strong. I haven't looked at their financial statements. Technically, it's possible that one or more of them won't even supply me enough information. But they actually are traded tickers on exchanges that I have access to. So there's at least that. So we did RGR today. Boom. We've already done the prep work for this one, so we'll be ready to do this one on Monday, and hopefully I can get the prep work for these two done over the weekend as well, so that next week is set and good to go. And then once we're done with most of this list, I'll probably reorganize my criteria I'm using on my screener, try to come up with a new list. But either way, so you can expect us to be looking at AMKBY, which incidentally is AP Moller Maersk B shares, which is a Danish shipping company. So we'll be taking a look at that on Monday. Hope you join us then. We stream 3 times a week, Monday, Wednesday, Friday, usually around the time that the market closes, which is about 1 p.m. Pacific time or Western time or whatever. So